How should people invest, and what is the correct asset allocation for this sort of environment?
Well, the investment environment going forward will be very different from the environment of the past. I mean, think about it as a zero and very low returning asset environment, because the liquidity that's in the market is driving the excess returns of all markets down to be low in relationship to the very low cash rate. So negative real returns, not good for cash and so on. The most important thing is to know how to diversify well. And what I mean by that is to go beyond just the traditional 60-40 stock bond mix, or even the same countries, and to broaden that diversification. To include in that portfolio assets that might seem unusual, to include some gold, to include inflation index bonds, to think about the currency exposure, to think about safety as different. Most people think that cash is safe. Cash is the least safe investment. It just doesn't have the same volatility to it, but it has, because they're producing so much cash, it has a negative real return. It's a tax that maybe 2% a year you lose money in terms of cash. So you have to think about risk differently, and you have to diversify best. That's the most important thing, to have a well-diversified portfolio. The uncertainties that we have today are so great in terms of all the things I mentioned, the tax policies, the geopolitical. Certainly we must experience it with the virus. Will the next wave come back, and how will it be there? Diversification can be achieved without reducing your expected returns because of the way that asset classes are priced. And then if you're going to take tactical bets from those, then those tactical bets, alpha on top of that strategic, well-diversified portfolio, should have highly diversified bets deviated. Liquidity is going to be more important than before, because things change in unexpected ways. Look at how, in many of the cases, the businesses that one would have thought was a good business, and let's say you're in private equity, and that you're with that company. And so the restructuring, the ability to rebalance and diversify, and to be cautious about making a highly diversified set of bets is, I think, the future. But thinking even of asset classes, thinking about the value of money. We look at asset classes and we say, oh, do I want my money to be in stocks, and which stocks? But we don't think about stocks, bonds. We think about those traditional asset classes, but we don't think about the value of money and what's going to happen in terms of the printing of that value of the money and how to diversify it well. So I think those are the things that have to be paid attention to, in much as they were important things in years prior to 1945. We're in a new paradigm.
I think you mentioned very clearly this idea around portfolio diversification. And over the years, as you say, equities and government bonds, they would normally have some ability to offset each other in certain market environments. We're in a situation now where government bonds yield not far from zero, depending on where exactly you are on the curve. Does that reduce their ability to provide a ballast to an overall risky portfolio?
Yes. But the interesting thing about that is when you look about when interest rates, let's say bonds, approach a zero expected return, clearly their ability to go up in value or interest rates to go down in value is limited. Or in order to have the impact, one has to leverage those a lot, and that's not desirable. But clearly through history, and I studied the last 500 years of cycles, going back to the Dutch cycle in terms of the Bank of Amsterdam and that whole cycle. In all cases, central banks will print money and devalue money when they get in that course. The basic problem of a depression is basically a debt liquidity problem.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
And so always through history, the choice will be reflation, even when you hit interest rates in the way that we're seeing now. And so to understand that the nature of the diversifying asset has shifted to be of the sort that I'm describing in terms of other assets that at that particular time benefit from reflation, because it will be reflate or die. And so we will always see reflation. And that's why in history, you see that all currencies have devalued or died over a period of time, particularly in such periods.
And you mentioned earlier that it's incredibly important at this sort of time to think about the currency exposure of a portfolio. I wonder if you could just expand on that a little bit.
Sure. Well, think of it this way. A bond or debt is a promise to receive currency. You're long the currency by being long in the bonds and so on. And so when debt is built up, and a lot of debt has been built up, but beyond debt, there's a lot of non-debt obligations, pension obligations, healthcare obligations, a lot of spending obligations. Those are like debt. And they all have to be met. And there won't be defaulting on that. It's politically unacceptable to default on pensioners and so on. So all of those obligations, insurance obligations, all of those liabilities are coming at us. And that then can be met increasingly by the printing of money. And so think about it. When you're holding a bond and it has no return and a negative real return, do you want to hold that asset? Who is going to hold that asset, particularly when there's so much printing of money? And that is the value, that is currency, that is cash. And so that issue, that risk, that there's a movement out of that is significant. So now we have to look at historical periods of when that were analogous to what's going on now. And that would, I think, be particularly the war years, the years when there are large deficits that are built up. There's the monetization. And so when we talk about yield curve control and interest rate controls and guidance, we're in a new world. I mean, think about it. It's so interesting. Where does the money come from? If you take Europe, for example, and you lend to banks at the central bank lends to banks at a -1%. And then so they'll take that credit. Then they can decide when to roll it or as they roll it forward. That means that there could literally be no debt service payments. So it is the means by which there's monetization and cash is being produced to deal with those liabilities. And that has an important implication in the value of cash, which is currency.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.